Good afternoon. Good afternoon, ladies and gentlemen. It gives me great pleasure really to welcome you to this session on stabilization and adjustment towards inclusive and sustainable policies in MENA. This is a session that will feature presentations by
recording in progress
by country teams and essentially hopefully cap the phase of the research side, and we will be looking beyond that in terms of policy outreach, and we have already done some stakeholder consultations in the context of preparing these papers. And I would like to actually also welcome Ishac Diwan, who is the principal investigator of this project, starting from the regional report, which was launched last year in October, and will be central theme in the conference, the 29th ERF conference. The first two sessions will be focused on the report, one from a policy perspective and the second one from a future research direction perspective. So without further ado, Ishac would give you much more substantive aspects, and as well as provide an overview of the agenda.
Thanks, Ibrahim. Good to see you. And thank you all for being here. I mean, you all come from far, and we've been meeting through Zoom too long, so it's wonderful to meet you in person, and for many for the first time. So our agenda is packed. So as Ibrahim said, this follows on the Commission report on debt and stabilization and recovery in the region. These are 6 case studies that we will study today. Then in the next 2 days, tomorrow at least, there are 2 plenaries on the subject. So much of what we learned today will go to the plenaries. And obviously this is the beginning and not the end of the story, because as many of our countries get in troubled waters, there will be much more to study. So this is kind of laying the ground for more to come. We're also interested in understanding what we can and clarifying research issues for the future as well, on how to stabilize and get the growth process going, and maybe take advantage of the crisis actually to do the kind of reforms that were not done for very long. Now, obviously we focus more on the economy than on the political economy here, but in this kind of situation, it's very hard to disentangle the two, and I think it's open for discussion on both fronts. So without further ado, the program for today, we're starting with 2 countries, Sudan and Lebanon, that are already in crisis. And so, for the other countries, maybe it's lessons on how not to get into the wall, or, how costly it is when you are there. But we also want to think about what it would take for these 2 countries to recover. And then we have 2 countries that are still in okay shape, Jordan and Morocco. And it's more about debt management and macro management in order to avoid the crisis. And then we have 2 countries, Egypt and Tunisia, that are at risk. And again, the topic will shift to what to do when you're at risk. Do you make an effort to avoid, or to try to restructure your debt? So different type of debates, and that's why we grouped them into 3 countries, into 3 panels. We started a bit late so that we can do hybrid and be connected to, all the way to the United States. And, that's why we have about 15 minutes for presentation. So it is going to ask the chairs to be strict and the speakers to do their best, because there's lots of material. I mean, already I'm wondering how I can put the case of Lebanon in 15 minutes. I think day to come. Let's get started.
Good afternoon, ladies and gentlemen. Many thanks to the ERF for allowing me to be with you today. And I am very pleased to be joined by my good friend from many years, and Reza Baqir. With your permission, I will delve in And if I speak too long, somebody please just cut off the mic or something. Thank you very much. Speak with you about the experience of the 1980s. Into this. Two things I cannot handle. Experience of the 1980s. What were the key issues then globally? Then what MENA went through in terms of debt crisis in the 80s, and I snuck in the 1990s as well. The key issues that we now face globally. Then what MENA the problems MENA faces today, and then some implications for what should be done. Very briefly, the backdrop to the 1980s debt crisis was a global economic downturn following the events of the 1970s, the commodity price increases in the 70s and the 80s. There were contractionary policies in the US and other OECD countries. Many of the oil exporting countries received considerable amounts of oil revenues, which then they recycled back to international banks, who then turned around and lent it to developing countries. With rising interest rates and debt service, there were inevitably some debt repayment problems. The debt restructuring process was very slow. First, because people were trying to learn how to deal with it. A similar problem exists today. And I'm stressing this because some people think what we're experiencing today, especially with China, is completely novel. Not only the Paris Club procedures had to develop gradually, but also, especially the American banking system, had to prep itself for debt restructurings. And this took many years. There were lost decades, especially in Latin America. There were debt crises, including in MENA countries. Well, okay. What were the key global issues then? The lenders were mostly official and banks, not bonds, bondholders. There was a fear of banks holding those debts going under. So that was a primary reason why the debt restructurings were delayed. Many restructurings didn't really work. Eventually, we had a more market-based menu plan after the banks prepped themselves for debt restructurings. And in the Middle East, Jordan and Morocco had benefited from the Brady plan. And the IMF changed its lending policies in putting in place what is known as the IMF lending into arrears policy in order to take away much of the power of the private lenders over the debtors. In Egypt, several countries had, in the Middle East, several countries had problems: Algeria, Egypt, Jordan, Morocco, Sudan, and Tunisia, mostly to cover fiscal imbalances and large import bills. The regional creditors and donors, because of the decline in the oil prices in the mid-80s, became more unable to help those countries. There were debt restructurings, but because of the first Gulf War and other things, they had considerable international support. There were the special cases of Iraq, whose debt was restructured, but under a completely novel approach then, which was under the auspices of the UN, supported by an executive order from the President of the United States, preventing banks from suing and attaching Iraqi assets. Syria has had its own issues. It's had a debt issue problem for many, many years, but the issue has been frozen, essentially. In the 80s, and the early 90s, there were many IMF lending and debt relief were conditioned on structural adjustment policies. Some helped growth, some not, but it left a lot of bad taste in the mouths of both the countries and the international community, with perhaps excessively intrusive policies in the countries. These were the reschedulings done by each country. I got this off the Paris Club website. And as you see, there were many, many, especially for Jordan and Morocco. What are the key issues today, globally? First, the geopolitical cleavages, which make any debt restructuring more difficult. Okay? Because countries need to now play, or try to play, and sometimes they overdo it, which camp they want to be aligning with. The region has also become quite different. It is the big lenders and the big donors of the Gulf are unwilling to give unconditional money anymore. And they're sending countries to the IMF. Bondholders are a big part of the issue globally, but there have been some architecture changes, collective action clauses, that help. Non-Paris Club creditors have become larger, especially China, and domestic debt has become now something to be put on the restructuring table. Overall, the global debt creditors have become much more fragmented, with a much more varied political set of political interests, rather than the relatively homogeneous Paris Club membership. There is lack of transparency about the amounts and terms of debts, especially in China, and the global debt restructuring framework, especially the Paris Club, has become ineffective. They haven't been able to keep up with the changes, especially of the rise of non-Paris Club creditors. I'll speak more about the common framework in a second. Debt sustainabilities are becoming more speculative because of COVID, climate change, and there is more room to play. There is an issue about the transparency of debt restructurings. IMF is now moving towards sharing its debt sustainability analyses, which should help. But the key issue is this: debt restructurings are going to be slow and painful, as the countries that have gone through the common framework and Sri Lanka are finding out. I don't know if you can see the details of this. It tries to capture the move away from bank lending, the pinkish areas in the 80s, more toward China and bondholders. The common framework doesn't really apply to most of the countries in the region anymore, because it's for the low-income countries. One key issue I would like to stress is the question of the vagueness regarding comparability of treatment. The Paris Club has about 3 ways of doing comparability of treatment. It's more of a clubbish way. There is constructive ambiguity about how the creditors sit with each other and decide whether what they've given is comparable or not. With the greater fragmentation of the creditor base, the issue of comparability of treatment is getting worse. Now, what can be done at the global level? First, you can strengthen the IMF's lending into arrears policies. The current lending into arrears policy, I don't know if Reza will agree with me, does give some holding power to China. And it may need to be changed in order to take away that power. Debt repayment standstills, although it is in the power of the IMF to do it, it is not done. When countries go into debt crises, there could be a standstill announced, so the pressures on debt service go down. More effective use of creditor committees, including the private sector, with sharing of debt sustainability analyses. and better definition of comparability of treatment. Maybe the best way to do it is to accept a uniform definition of NPV cuts as the only measure. It will make it more easier. And the IMF and the World Bank have recently put together a debt roundtable. That is useful, but it will not do as much as some people think. Now, where do we stand in the region today? Many countries have high debt. Okay? Lebanon is, of course, in default. Tunisia, Sudan is in HIPC, but the rest are on the margin. Perhaps Egypt is the one with the most difficult situation. These countries do not have China as main creditors, as far as I know. The data that I've seen, except for Tunisia, Sudan, China's credits are between 0 and 5% of GDP. For Sudan, it's 5 to 10% of GDP. Again, regional creditors are less willing to help, and the social contracts prevailing today in the region do not allow large fiscal consolidation. Now, I've stolen this from FDL. First of all, this column comes from the most recent IMF reports. Okay. Lebanon is in default. Others are considered sustainable, but if you know the way the IMF does it, it's usually if X, Y, Z, E, F, G are done, so it gets precarious. This is particularly true in the case of Tunisia, which they say it is sustainable, but almost if the country changes many of its characteristics. Domestic debt is particularly important in Egypt. Lebanon's is mostly external creditors. Implications for today. The countries really need to have sustainability problems, but they also have liquidity problems. For example, Egypt has a gross financing need of 35% of GDP. Among the emerging market countries for which the IMF provides public data, it is the highest in the world, followed by about 27% for Pakistan. Restructurings will be politically difficult and slow because creditors, including regional ones, are likely to ask for structural changes, which will take us back a bit to the structural programs of the 1980s. There will be a temptation to fix some of the debt problems, especially those that have high domestic debt through inflation. Okay. The best suggestion I have, and we can get more into cases as we go along today, is do not wait. Start preparing for restructurings early. Okay. Fiscal consolidation, something now that the IMF admits to very clearly in their most recent World Economic Outlook chapter. Fiscal consolidations by itself will not give you huge success in debt reduction. Growth, of course, is going to be difficult. I know one of the themes of this conference is growth issues, but in my experience, during periods of stabilization, you're not going to get a lot of growth. Stabilization, in many ways, by definition, means cutting back excess demand. And those are not going to be expansionary. Having said that, don't focus just on fiscal consolidation and restructuring, but also, as the theme of the report is, focus on growth, but this growth impact will take, at best, will take very long. And they will not be strong enough to overcome the liquidity and sustainability pressures that countries face today. Thank you.
Thank you very much. Reza, you have 15 minutes so that we can have another 15 minutes for discussions.
You know, I'm going to interfere for a second because we didn't decide who was going to chair the session before, but so Ibrahim's chairing, I'm co-chairing. I want to do what I forgot to do, which is to introduce our speakers. So Adnan Mazarei, who just spoke, introduced himself. Many of you have met him when he was at the IMF for a long time, in command or second in command of the IMF Middle East Department. And he's been since at the IIF doing wonderful work. Reza Baqir was in Egypt as the IMF res rep. He was later at the IMF the head of the group that is in charge of debt. He'll tell us more about that. And after that, the head of the central bank in Pakistan. And in the past few months, a colleague of mine at the Kennedy School, visiting scholar, and now with the Alvarez group. So these are the two most knowledgeable people about debt and adjustment in the Middle East that we have with us this morning. Welcome.
Thank you, Ishac, and a real pleasure to be with all of you today in this very distinguished session today. Thank you very much for the invitation. In fact, I have to thank Ishac. He was the one who first reached out to me about the conference here and to participate. So I'm really delighted to be here. And as Ishac mentioned, I used to live here in Egypt. Well, not too long ago, but what seems like a very long period ago, from 2017 to 2019. I moved here from Washington, D.C. As the IMF senior resident representative to open the IMF office in Egypt. And those 2 years were absolutely delightful years for me. So to all the Egyptians in the room, I just want to say that Egypt has a very, very dear space in my heart. And it's really good to be back in Cairo. I will be talking, sharing my thoughts on the topic today of the debt overhang, comparing the 1980s and the current global crisis. And I'll be sharing my thoughts on some of the same points that Adnan has mentioned. But before I get into that, I just want to be transparent about what is the perspective from which I will be talking, because in my view, people's experiences shape a lot what they come to believe, and it's good to be transparent about them. So as Ishac mentioned, I used to be the IMF for about 20 years, and 4 of those years I was the chief of the debt policy division of the IMF in the IMF Strategy Policy and Review Department. Now this division is in charge of all IMF policies on sovereign debt, including debt sustainability analysis, including sovereign debt restructuring. And at that point, I was the advocator-in-chief, or the person who would go and defend all of the IMF policies on DSAs, debt restructurings, and the whole gamut. I resigned from the IMF in 2019. In fact, the senior res rep job in Cairo was my last job at the IMF. And I resigned to do public service back in Pakistan, where I'm from, and I was appointed the governor of Pakistan's central bank. Now, that's the second perspective from which I talk today, because suddenly, from being from the IMF side, I became the governor of a high debt country. And now, the first job was to actually negotiate an IMF program, and after having spent 20 years giving prescriptions to other countries, I was now, for the first time, on the receiving end of getting prescriptions from my colleagues. And I was suddenly beginning to discover it's a very different world when you're on the other side, and no matter you may have the best intentions, sometimes there are very real constraints that prevent you from doing something. So that's the second perspective. And the third perspective from which I'll be speaking today is what I do now, which is I'm a researcher, and also I'm a consultant and advisor working in the private sector. So I wanted to be very clear upfront from the perspectives from which I'd be speaking. Now, I'm going to say a few words in the form of 3 questions, and then with a word on the outlook. And the first question that I'm going to talk about is the debt situation today as bad as it was in the 1980s? That's number one. Number two, what I'm going to talk about is, can we be confident about the outlook for resolving the debt overhang that is with us right now? And my third question is going to be about the framework for sovereign debt restructurings and whether we can be hopeful that the current issues that are with us regarding common framework and others can be resolved quickly and getting a timely framework for debt restructuring. This is an area where I've been working a lot with Ishac as well. And then I'll just end with how I see the outlook for developing countries. So first, is the debt situation as bad as on the eve of the HIPC crisis? And first of all, I would encourage you all to read an IMF paper that has recently come out on this subject. And it's a paper pretty much with the same title. It's a working paper with all of the IMF senior officials that work on these issues. And the conclusion of that paper, it almost seems to have been written with the intent to argue that the current debt situation is not as bad as it was on the eve of the HIPC crisis. And they compared the low-income countries today with their debt indicators, solvency indicators, liquidity indicators, and they go back and they look at the debt indicators for what were then the HIPC eligible countries, and then they show by metric after metric that at a systematic level things are not as bad as they were. And I think all of those points are well taken. I would just propose 3 caveats to that analysis when I read it. And my first is that, you know, that's a paper, and rightly so because that's how it defines its scope, is a paper about low-income countries. And HIPC was an initiative for low-income countries. So the paper does not talk about what to me is the glaring problem right now, which is in addition to low-income countries, there are lots of middle-income countries that are in very high debt and debt overhang and with difficult circumstances ahead of them. Those are not spoken about. That doesn't mean then, therefore, we don't need to worry that right now things are not as bad. Actually, we need to worry more. I come from Pakistan. Pakistan is the world's 5th largest country, and Pakistan has a debt to GDP ratio of more than 80%. And Pakistan is a country where if you look at the prices of our Eurobonds, many people speculate about the fact whether that would in fact be the next restructuring. My good friend Adnan put up statistics about countries in the region. Egypt is the largest Arab country in the world with a high debt to GDP ratio. And if you look at other middle income countries, you look at Argentina, you look at several others, I think if you look on a per capita basis today, I don't think you would reach the conclusion that the debt burdens today in the world for developing countries as a whole, including low-income and middle-income countries, that today things are better on a systematic basis than they were before. And I want to just, as a corollary to that, say that to me the metric is not whether a country is already in default. The whole thrust of the literature on debt overhang is that when debt is high and high beyond certain levels, even if a country is not in default, what high debt does to depressing growth, and particularly in lower income countries where poverty levels are high, the toll that that takes on living standards, both on lives and livelihoods, that to me is the real cost of having a debt overhang, even if a country is not in default. So that was the first caveat about low income versus middle income countries. The other 2 caveats, the second is that if you look at some of the liquidity indicators that even the low-income countries sample have right now, they are beginning to trend up to the same levels as pre-HIPC. That's my second point. And the third point that I wanted to make is that when we look at the debt statistics on the eve of the HIPC crisis, one has to be careful about one thing. And this I speak from my years. So when I was the head of the IMF debt policy division for 4 years, I was also the IMF's representative to the Paris Club. So I went to the Paris Club meetings maybe 30, 40 times in my life. And one of the things that I wanted to point out is that in the debt statistics before HIPC, I believe that they also include the arrears that get built up, because those countries back then ran arrears for a number of years. The interest on arrears is a lot higher than the original interest. And even if you start with a small base, the contribution of that amount to your total debt stock increases very rapidly. Right now, countries are not running arrears, so we may be comparing slightly apples to oranges, where we have countries' present debt stocks, and we're comparing to countries not just principal, but also the accumulated arrears, which have accumulated at very high rates of late interest. So the first question was, is the debt situation as bad as on the eve of the HIPC crisis? I think if you look in a broad sense, to me, the answer is less clear than arguing that today things are a lot better on a systematic basis, as in the HIPC paper from the IMF. Now, the second question was about the outlook for resolving the debt overhang. And I'm not talking about debt restructurings right now. I'll come to it in a minute, but there are other ways to reduce debt to GDP ratios, right? You can run primary surpluses, you can raise your level of growth, you can have low real interest rates, you can have high inflation. There are many ways to get debt down. And because I'm running out of time, I'll just point you to a recent study that comes out of one of the papers presented at DebtCon 6 by the Inter-American Development Bank. They've done a comprehensive study where they look at what explains debt reductions. And they come to the conclusion that it is either inflation, as has happened this past year, and particularly surprise inflation, or low real interest rates, which are the two biggest factors that explain debt reductions. Debt restructurings actually generally do not lead to sustained reductions in the debt to GDP stock. There are two exceptions. One is HIPC, and the other is Brady. And remember, both of them took a lot of international coordination and work to happen. So the point of this example is that when just countries on their own stumble into debt restructurings, on average, they don't reduce the debt stock on a sustainable basis. So that was the second question about how confident can we be about the outlook for getting out of a debt overhang. And the third question that I wanted to talk about was about what hope do we have for an efficient framework for sovereign debt restructurings. And Adnan already spoke about the common framework and its problems. I just wanted to mention that what are the solutions that have been proposed? And I just wanted to recap those. So I presume everybody understands what the common framework is. I won't get into it, but if people don't understand, happy to talk bilaterally about it. So maybe I'll take that as a point of departure and just talk about, what are some of the proposals. One is, as Adnan mentioned, to use the IMF's lending into official arrears policy. And there I have a slightly different perspective than Adnan, which is that I don't believe it gives China any holdout power. I think the issue is more a perception on the part of the IMF staff that if they use this policy in the context of China, what they're afraid of is that after the program period, suppose they overrule China, they lend even while a country is running arrears to China. What they're concerned about is that after the end of the program period, China could use its influence on that country to get repaid on its arrears quicker than that country makes payments to other creditors. And that would, in the views of the IMF staff, raise two issues. One is of intercreditor equity, because essentially IMF money and other multilateral money would have been used to pay out China. And second, that other, aside from intercreditor equity, the second issue is debt sustainability. If that country starts making big payments to China afterwards, it would go back into a situation of debt unsustainability. So that's one solution, which is to use the lending into official arrears policy, but that's why it's also not been used. A cousin of that, or a solution that follows from that, is one proposed by Lee Buchheit and Mitu Gulati, which is to use most favored creditor clauses. Now, for those of you who may not know what these are, and I didn't know what they were until I read this blog piece by them, is that these are clauses that have occasionally been used in commercial debt that has been issued by sovereigns. And what they do is they say that if a sovereign or if a commercial party, now I forget, after a restructuring deal, ex post, revises it to give better terms to one of the parties to that restructuring, it will be compelled to give the same terms to all the creditors who participated in the original restructuring. Because this virtually means that it would be impossible for that debtor to service all of them, the idea is that no debtor would ever ex post give more favorable terms to one of the creditors. Interesting idea. The downside with this is that, number one, it's only been used in very few commercial contracts. Even then, it's never been tested in commercial contracts. It's never ever been tried or tested in a sovereign context. So we don't know whether it would work or not. A third solution is continuing on this vein about trying to coerce China into, I guess the word is cooperating, which is a solution from people like Ann Kruger, who used to be the former IMF number 2, and also one proposed or recommended by an editorial in The Economist recently, which is, that's sort of the harshest version, which is to say that if countries have a debt restructuring, China does not participate or cooperate, and then that country repays China on more favorable terms, then the IMF should block access to that country and never lend to it again, or to kick it out of the IMF. So that, as you can imagine, is a pretty severe solution as well, and very, very unlikely that a place like the IMF would ever. Now, I was mentioning these. This is the third point that I was talking about, the outlook for the framework for sovereign debt restructuring. That there's one common theme in all of these, which is to somehow coerce China, using either soft or medium or hard threats. And in my view, this is not the right approach, because given that China is the largest creditor in the world, not just to developing countries, but to the whole world. China is the largest creditor to the US, for instance. I think any solution which does not have the ownership of the largest creditor in the world is not going to be a solution that is going to last. So I wanted to address these three questions about whether the situation is as bad as it was on the eve of the HIPC, how confident can we be that, setting debt restructurings aside, there can be a sharp reduction in debt to GDP burdens, and some thoughts on the framework for sovereign debt restructurings. And I want to end on just my thoughts on the outlook, given this debt situation and some of the remarks that I shared. And my ending note is unfortunately very pessimistic, and it's for the following reason. We had HIPC. To me, the bigger lesson from HIPC is not that developing countries got a debt reduction. To me, the biggest lesson from HIPC, and what's most glaring, is that all those bilateral creditors then drastically shrunk their lending to developing countries. If you look at statistics today, net resource transfer to developing countries falls from 8% of GDP, these are IMF statistics from the same paper, back in the 80s, to 2% of GDP right now, which means that all of those creditors that gave debt relief, I'm talking about bilateral, said, we've learned a lesson, we had to restructure our debt, we're not going to lend to developing countries again. Now, we are raging a battle against the new creditors that are essentially being told that you have to give now debt relief, and I'm not making a normative argument right now, I'm just making a factual argument. And so if the past is any guide, then if the current new creditors like China and others also take the same lesson, if they have to give debt relief, that they are not going to, in the future, lend to developing countries, then I want to end on this very serious and, to me, a pessimistic note and a big problem for the developing world, that we're going to have, through two waves, one systemic, HIPIC. This wave may not be systemic. It could be individual cases, but a creditor learns their lessons. And if we have the current creditors also wanting to scale back at a time when developing countries' needs have grown and are going to continue to grow, including for purposes like global public goods, including climate. And we have a situation where multilateral development banks like the World Bank are also capacity. They are constrained on how much they can lend and very little appetite to increase their capital. Then we have a real problem for how investment in developing countries, including for global public goods, is going to be financed. So on that very pessimistic note and without any solutions, let me thank you for your time. And then I look forward to our discussion in the afternoon when Adnan and I will be together on the cases on Tunisia and Egypt, respectively. Thank you.
Thank you very much, Reza. It's really fascinating. We have 10 minutes. I would like to give 5 minutes for questions and then 5 minutes to our two keynote speakers to respond. Mustafa.
Thank you both. Just a clarification question to on the last speaker. Clarification, because you said that the research shows that the restructuring does not reduce debt. That statement, is it on its own or as part of a package? Because if it is just statement that restructuring does not reduce debt on its own, there is no other action, no other policy changes or no other, I think, yes, probably that's, but I always thought that restructuring should be part of a package.
Yeah. So the statement is a factual statement. It comes from looking at a large sample of countries that have had a debt restructuring.
Yes.
And then defining some empirical metrics as to how much does the debt to GDP ratio or other metrics of debt come down after the restructuring. And as an empirical matter, so you have a good question as to what else is happening in the background and whether there are some countries that put together a number of other policies as well, such that very well can happen. On average, it does not. And I'll tell you, actually, typically, restructurings do not reduce the debt stock. They reprofile the debt stock. And this particularly happens in the case of official creditors. A case in point is Pakistan right now. Most of Pakistan's debt, Pakistan has debt maybe of around, say, $90 billion or $100 billion. Out of that, only now $7 billion is owed to Eurobond holders, and maybe 2-3 more to external commercial creditors. Now, the rest is either official external debt, split between bilateral and multilateral, or domestic debt. Okay? If you think of the external, whether it's to bilaterals or to multilaterals, they hardly ever write down. Multilaterals did not until we got HIPIC. It's a time-honored tradition for bilateral official creditors to not give any debt reduction upfront. In fact, people don't dwell on this. If you go read the original document of the Common Framework, it actually says that we should try not to give a debt reduction. And the first preference would be for just a debt rescheduling. If you look at the history of Paris Club, until HIPIC came, it is littered with examples of repeated debt reprofiling. Poland is a case in point, which in the 80s came to the Paris Club. It was insolvent. The Paris Club gave a rescheduling, and it took 5 more reschedulings over 10 years before they decided that actually it's a solvency problem, not a liquidity problem. To me, it's the same happening with China and others right now. It's not a China problem to me. It's just this is the way bilateral creditors, or for that matter, official creditors think.
Thank you. Atif?
Seems quite absent
Let
now.
me say that let us collect like 3 questions and then we answer also that for the interest of time.
Okay. I mean, absent from this discussion is some of the old solutions. What about swap of debt into equity? So that at least you expect from countries to respond and to pay depending on how their economy is doing. Now it's a fixed interest rate. You have to pay it no matter what your condition is. What about the issue of odious debt, where some of the lenders have given debt to countries and have not taken into account the fact that it's not representative of their people, and now the people have to pay for it, and this government corruption has put us in this. What about the third one, which is to a great extent, I remember as a graduate student, we did simulations. If the people don't pay their debt, the banks may lose. But this money that they have, the foreign exchange, they will basically import, and that the countries at the end, give it a 10 years simulation period, they're doing better than if they were paying the debt, because their exports would rise, the export industries would be better off. The banks may not be, but the total of the world economy and total welfare is really improved, not getting any worse.
I'm sorry. I have a question about the role of the IMF to participate in this crisis. Why? Because according to my experience and my studies about the debt sustainability in Egypt, the IMF asked Egypt to raise the primary surplus. And this is self-defeating. I can prove it. It's self-defeating. When a country like Egypt, with almost deficit in the primary, and you ask to maintain 2% of their GDP as a solution for the debt, we have the self-defeating, and now Egypt is in worse position rather than. So please, according to your previous work and your current position right now in Pakistan, how do you see this solution insisted by the IMF to save the debt sustainability, and how to react to that?
You mentioned China. Just a question. There was a recent sit-down between the usual suspects and China on Chad. Is this experience as positive as I seem to have understood, or I got it wrong?
The common framework that you talked about applies, as you said, to the low-income countries. What's your understanding of the framework where China, like in Sri Lanka, for the middle-income countries? I mean, surprisingly, in the case of Sri Lanka, China gave financial assurances much more rapidly than in the case of Zambia. So what's the framework? And number two, we haven't gotten to bondholders now in a long time. I guess we'll get to them in Ghana and in Zambia and in Sri Lanka soon. Do you expect the CACs to work well, and the lending into arrears to work well, and the private creditors not to be a problem, or do you expect that it will also become a big problem?
So, shall I ask Adnan and Reza to each take 2 minutes to respond, so that you can finish in time?
We did some dividing of the roles already.
Okay, you can take 3
On
minutes.
debt equity swaps have been there. It's a conceptually very nice thing. It's been done a little bit. It hasn't been pervasive. Okay, in good part because creditors want to be paid now. There is also, in a similar vein, proposals to have green for debt swaps. Those are also going to, those again, in principle, wonderful. They're going to be very small, but also not easy to administer. Because those projects, the things that are needed to be done, will take very long. On odious debt, ODS debt, you and I intuitively may agree and see one and immediately say that's odious. It is, however, a legally unpinned down notion. There, as far as I know, and Reza, please correct me if I'm wrong, there isn't a legal basis of international court decisions defining it and setting precedent for doing so. In practice, there have been debts such as Iraq under Saddam Hussein. In that spirit, they've been restructured, but there is no legally bound definition or framework for it.
Thank you, Adnan. So I'll just pick up from ODS debt. I appreciated the question, and let me share something from my personal experience. When I used to go to the Paris Club as the IMF representative, sometimes, this question would come up. What about the lending that has been done to regimes that, are very questionable? I was always told by Paris Club creditors never to talk about ODS debt. And it was a topic that would always, be not spoken about. And so that's all I can share. I hope that's useful. But I want to come to a question on primary surplus. And I wanted to also clarify that I'm no longer the governor in Pakistan. My term ended in May of 2022. It was a 3-year term. So I can speak as an ex-policymaker. And you asked about the primary surplus, and I think my view is slightly different. In most of the developing countries that I have worked on, and this is not now a comment about Egypt or Pakistan in any specific country, in most of the countries that I've worked on, I think government spending has not been that productive. And therefore, raising a primary surplus to me has always generally has had more benefits than costs, because in my experience, it has had less of a trade-off in terms of growth. I'll give you one factoid. During COVID, while in many countries, countries increased their debt to GDP ratios and increased their deficits, Pakistan actually reduced both its primary deficits and its debt to GDP, yet it had a very good recovery out of the COVID crisis as well. So in general, I'm very skeptical about arguments that you need deficits because you need high quality growth. To me, I think it's probably the opposite. Then there was a question about framework for middle income countries, I think from Ishac. You are right that middle income countries that have approached the outside the common framework, the financing assurances may have come quicker. I just want to remind that this is the beginning of the process. And even the letter that came from one of the creditors that you mentioned, it took a little bit of time because apparently there was an earlier version of the letter which the IMF staff had not found that it was acceptable. So let us just hope that now it delivers what is needed that is consistent with the debt sustainability analysis. I am not sure if we are at a stage where we can already draw lessons about what it means for the common framework. And then there was a question about bondholders, and I'm going to share my own now personal view, and it may be controversial, but I shared that also as now an ex-policymaker. In my experience, it's much easier to deal with private creditors than with official creditors, and particularly bilateral official creditors. And I'll tell you why. If I am a policymaker of a higher-ed country, and I'm dealing with private creditors, I know what is their objective function. I know what motivates them. And I know that if I can successfully convince them that the deal that is being offered right now is better than the next best deal they might be able to get if they hold out, then the job is done, and they will participate in general. So personally, I find that private creditors are easier to deal with, and if there is a good faith process that has been followed where the country officials and the IMF team have engaged early, have shared as much of the information as they can, and particularly the IMF team has been open and not condescending and participatory, I think you can get good outcomes. Bilateral official creditors, the reason I find them harder is because you often don't know their motivation. It is true that they are also lending for certain returns. Nobody gives money for free. They're getting something out of it. But as you, as a governor of the central bank, you may not be privy to what is that conversation that has taken place between your head of state and the head of state of a giver. And when you don't know their motivation, whether they stay in the country or take their money out or whether they roll over, it's a lot more unpredictable than it is, in my experience, with private creditors, where one knows what language to speak with them.
If you can just add 2 points. One on the surplus issue. You're absolutely right. Large surpluses hurt demand. The reason it is done is because programs have a very short horizon. What matters is at the end of the day whether that deficit is financed or not. That's why many people call us who worked in the IMS or do as accountants, and not as a compliment, I should say, because we kind of insist where the numbers have to add up. The solution to that is if there is a lot more money spread out over many years. That, however, means that the lenders, including the IMF, have to put a lot of faith in the borrower that they will do reforms over time. The experience in the fund is that once that is done, primary surpluses are lowered, then they won't do the reforms. And there is no such a thing as unconditional money in this business. Thank you.
Thank you. Thank you very much. Big hand to our two distinguished keynote speakers.